Many people examine their cash reserves and ponder a critical question. Is $10,000 enough to start building wealth? Do you need a high-paying corporate job before it's worth investing? What happens if you invest your money and the market collapses tomorrow? If you have cash sitting idle in a savings account, let's strip away the hype and run the numbers, starting with exactly $10,000. We will explore how a genuine investment allocation works, why the beginning phase can be discouraging, and how the mathematics ultimately transform your investments into a wealth-generating engine. First, let's dismantle a common myth. What are you really buying when you enter the market? The financial industry often complicates simple concepts with jargon, keeping everyday people dependent on high-fee mutual fund managers. Imagine you walk into a large wholesale warehouse. You could spend hours purchasing individual shares of various companies, hoping each management team performs well. Alternatively, you could go straight to the front desk and buy a single pre-packaged container that holds tiny pieces of thousands of companies simultaneously. This container is an ETF, exchange-traded fund. One transaction offers you instant diversification. If one company fails, others in the ETF mitigate the loss. A single stock is like betting on one horse. If it stumbles, you feel the impact. While actively managed mutual funds also offer a basket of investments, they typically charge between 1 and 2% of your total net worth annually, regardless of performance. An ETF, however, mimics an index with minimal human intervention and charges a low expense ratio. This expense ratio is the first filter we use to build a solid portfolio. To create a robust wealth strategy, your capital must pass 3 distinct filters before investing. Filter 1, an expense ratio under 0.2%. High fees are silent leaks in your financial strategy that could cost you tens of thousands over a 30-year career. Filter 2, understand what the fund tracks. The label on the box tells you little about the underlying companies. You need to know the index to understand your investment fully. Filter 3, a proven track record through various economic cycles. We're looking for stability, not trendy funds that go viral on social media without real history. Now, let's build the Net Plus allocation model using a one-time investment of $10,000 without any additional contributions. We will allocate this capital across 3 carefully selected funds, each with a specific role. Fund 1 is our foundation, a broad market ETF tracking the 500 largest, most capitalized corporations in the U.S. This fund captures the growth of the entire domestic economy and contains tech giants, retail conglomerates, and industrial leaders. It has a minimal expense ratio of just 0.03% and an average annual appreciation rate of about 11%. Its purpose is stability, ensuring your investment remains solid through various market conditions. Fund 2 is our accelerator, an ETF tracking the top 100 non-financial innovators, focusing heavily on technology and digital infrastructure. This fund sacrifices some stability for potential high returns, with a historical average annual appreciation rate of 16%. Its purpose is to drive growth and capitalize on the rapid advancements in technology that shape our world. Fund 3 is our geographic balance, an international ETF holding shares in over 8,000 companies outside the U.S. This fund operates at a low cost, offers strong dividends, and ensures that your financial health isn't entirely reliant on the U.S. economy. Its purpose is to provide balance and mitigate risk from market fluctuations in any single country. Here's how we allocate our $10,000. We put 50%, $5,000, into the foundation fund for stability, 30%, $3,000, into the tech accelerator for growth, and 20%, $2,000, into the international fund for diversification. This blend creates an optimized wealth system with an average annual appreciation rate of 12.2%.
That percentage is the mathematical engine that will drive your wealth over the next 30 years. However, this compounding journey doesn't progress evenly. It unfolds in 3 volatile phases, and misinterpreting the first phase is why many beginners give up. Phase 1, Year 1 to Year 10. You invest your $10,000, activate automatic dividend reinvestment, and wait patiently. After 1 year, your investment grows to $11,220. To a novice, this seems slow and unexciting. They may question the value of their discipline for such a modest gain. Think of it as a heavy flywheel attached to a generator. At first, it feels immovable. You sweat and strain, pushing with all your might, but it only budges slightly. It may seem pointless to an observer, but this effort is essential to overcome inertia. By year 10, your investment grows to $31,620. Your snowball is finally building momentum, and you are beginning to see the fruits of your labor. Next is Phase 2, Year 10 to Year 20. The duration is the same as Year 1, but your capital has tripled. Your portfolio surges from $31,620 to $100,000. The line on your growth chart is now steeply upward. You've crossed into 6-figure territory, the base camp of long-term wealth. This is a significant psychological milestone that reinforces the importance of patience and discipline in investing. This leads us to Phase 3.
Compound interest transforms from an abstract concept into a tangible force. In this final decade, your portfolio experiences explosive growth, reaching a final valuation of $316,000. It took 20 years to accumulate the first $100,000, but just 7 years to gain the next $100,000, and under 4 years for the third. Your initial $10,000 has turned into over $300,000 in returns, illustrating the power of time and compounding. Now, what if you have a genuine 30-year horizon, a high tolerance for volatility, and want to maximize your investment potential? We can adopt an aggressive growth model. First, we remove the international fund entirely. Then, we replace it with a concentrated tech sector ETF, focusing on over 300 rapidly growing IT companies with a historical appreciation rate of 21%. We adjust our allocations, 40% into the foundation, 35% into the Tech Acceleration Fund, and 25% into the Hypertech Growth Engine. This increases your blended annual appreciation rate from 12.2% to a blazing 15.6%. Let's examine the long-term trajectory of the aggressive growth model. Year 1 ends at $12,560. By year 10, this model reaches $42,600. By year 20, your $10,000 has transformed into $100,000 in the starter model, but has exploded into over $181,000 in the aggressive growth structure. Finally, at year 30, while the starter portfolio finishes at $316,000, the aggressive model reaches $774,000, over $450,000 more from the same starting point. The difference lies in the structural risk profile you are willing to accept. The primary barrier to building substantial wealth isn't the math, it's behavioral. Many investors falter because they can't tolerate the initial silence of their investments. When the market dips by 20%, and it will, their instincts urge them to act, often resulting in losses. The most expensive instinct is to react. Your directive is to do nothing. Open your brokerage account, automate your settings, activate dividend reinvestment, and let time work its magic. This is Net Plus, where finances become understandable. Subscribe for deep dive lessons that resonate and empower you. Focus on protecting your assets and let time compound your wealth. By establishing your target ratios today, you transform idle cash into a disciplined, automated tool for future autonomy. Choose your model,
Fund your investments and let the wealth engine run. Execution beats speculation every time. Let's begin your journey to financial freedom and build a legacy that lasts.